we're on this.
God, we haven't done this in such a long time. I'm Victoria. I'm here with James, aka Simon Black, who wrote a really interesting, very important article today. And I think this is one of these topics that we need to discuss in depth, I think. And the topic is inflation.
Yeah, it's complicated. It's a complicated topic. Inflation is a word that's thrown around a whole lot, like a lot of words. And honestly, a lot of people use it, but it's a word that is very poorly defined. So I think before we really talk about inflation, we kind of have to really talk about what it is and kind of how it all works. So we're gonna let's go back in time.
All right.
That's how we used to always start these podcasts when it was just kind of me staring at my computer and say, we're going to go back in time. And so we're going to go back in time again. And now this one is in the very recent past. Because what we have to understand inflation, we have to understand the completely ridiculous charade of central banking and how that works. So we're going to need to understand a little bit about central banking and money and the nature of all this. And so we'll start with what happened in the last cycle. And now this is something for our Total Access members that are listening. You may recall early in the pandemic last year when they started printing all this money, and we did a presentation, and I said, well, here's a bunch of different scenarios that might happen. One of the scenarios is that we could see significant inflation. One of the scenarios is that we could see sort of a return to the last cycle. And that's what I want to talk about, is what the last cycle looked like. So remember, we had this massive financial crisis in 2008. We had all these banks that basically collapsed. The whole entire financial system needed a bailout. The entire economy needed a bailout. You had all these companies ranging from, big banks to General Motors and all these companies that needed big government bailouts, and the government was sending money to people. I mean, it was a total disaster. I mean, up to that point, it was the biggest, bailout ever. And now like it just seems minuscule by comparison to these massive bailouts that they've been doing with COVID, because there's this virus, and so they conjured trillions of dollars out of thin air and trillions upon trillions of dollars in debt. But anyhow, the last cycle was this financial cataclysm, and the entire economy was really on the precipice. So the government came in big with all these bailouts. The Federal Reserve, the central bank of the United States, the Federal Reserve came in and very early in the crisis, they slashed interest rates. This is what they do. They cut interest rates and they began expanding the money supply. Now, there's a term some people may remember. In November 2008, the Federal Reserve announced this thing, quantitative easing. And quantitative easing was this program that they were initiating. Nobody had ever heard of that before, had any idea what it meant. But basically, quantitative easing was Fed speak, PhD economist, central banker lingo for, we're just going to create this giant orgy of money and flood the economy with it. That's basically what quantitative easing was. And so this is how central banking works. You have this committee of people, which, by the way, this is a completely unelected committee. What a lot of people don't realize is that central bank, the people that run the central banks, the open market committee, the people that decide how much money to print and what interest rates should be, that committee is pulled from the various Federal Reserve Bank presidents. And the Federal Reserve Bank presidents are appointed by the boards of directors of those various Federal Reserve banks, which many of whom are actually picked by the big commercial banks themselves. So it's a long way of saying that the big banks like JP Morgan and Bank of America and these guys actually get to pick the people, or at least have, let's say, generously, substantial influence in the people who end up on the committee that gets to control interest rates and gets to print money and basically essentially loaning money at 0% to the bank. So just imagine that benefit of being able to get to pick the person who has the authority to loan you money at 0%. I mean, what a deal. Nobody else gets
not a bad deal.
Right, not a bad deal, yeah. But that's basically how the banking system is. And so central banking in the United States, you have this committee And again, it's not. I mean, these are extraordinarily powerful people. They're not. We're supposed to live in this representative democracy and the republic and so forth. But nobody gets. When is the last time anybody went out and voted for their for their local Federal Reserve Bank president? It just doesn't happen. And so you have this unelected committee, and they get together and they decide. They have meetings. In fact, they're meeting right now. Depending on when you're listening to this, it's Tuesday, June 15th, 2021. So they're in a meeting right now, and they're making certain decisions. And the decisions they make are essentially where they want to expand the money supply or contract the money supply, raise and lower interest rates. And the way that they do that, when people kind of use this term, and I'll say it a lot of people say it a lot, they say the Fed's printing money. And of course, that's a metaphor, that they don't actually have a physical printing press. When they do that, it's all electronic. 90+% of the money in the money supply is just all electronic these days. But when they do that, they're essentially creating money. They expand the money supply, and they do that by buying assets, right? And so the Federal Reserve, like any business or any individual, has a balance sheet, and you can look at the Fed's balance sheet. They print it every Wednesday, and they have a report they put out every Wednesday. It's called the H41 is the report. And you can look this up, and anybody can see it. It's public information. They publish it every week. And it shows, like any balance sheet, their assets and their liabilities and their equity. And so going into the last financial crisis, the Fed's balance sheet, they had about $800 billion of assets, right? Anybody knows accounting, you have that on one side, you've got assets, on the other side, you've got liabilities and equity. And the two sides always match. And so they had about $800 billion in assets. Well, today they have, by the way, they have 8 trillion. So they've 10x'd their balance sheet. This is every entrepreneur's dream, right? 10x your business. Well, the Fed is 10x'd its business. So we've had 10x, the 10x Fed. When the financial crisis hit, right before, again, they were at about $800 billion in assets. And those $800 billion of assets consisted primarily of, basically it's only a couple of things that the Fed buys, right? They buy, US Treasury securities, so 30-year bonds, 10-year notes. It's just a little, just FYI for nomenclature, you impress your friends at cocktail parties when you talk about finance. So when we talk about Treasury securities, you got 3 different types. You've got bills, notes, and bonds. And kind of the general sort of category for all of it, you could say bonds, but technically a bond is anything that's more than 10 years. So that's why you talk about a 30-year bond, a 10-year note, or like a 90-day bill. Those are the biggest, kind of most famous ones. So it's like a 90-day T-bill is basically a treasury security that matures after 90 days. And a 10-year note or a 5-year note is something. So anywhere from 1 to 10 years is a note, and anything above 10 years is a bond, and anything less than a year is a bill. So the Fed owns all these different securities. Most of them are like 10-year notes and 30-year bonds. The other thing that they own a whole bunch of are these mortgage-backed securities. And you might be thinking, wait a minute, those mortgage-backed securities, weren't those the toxic assets from back in the last financial crisis? Yes, that's exactly what they were. They're the toxic assets from the last financial crisis. So these are things that, like, when you go out and you get a mortgage from your bank, then the bank goes and kind of starts to package all that stuff up, and they sell them off to other banks that in turn package even more of these loans up. And so you have all of these mortgages that are pooled together and into this big bond, basically. And so and these bonds are huge amounts of money, because otherwise you talk about a $400,000 mortgage, $1 million mortgage. That's chump change for these huge banks. So they need big fungible securities. Fungible kind of meaning that they're all the same. Right? That's a financial term. Fungible is like, you say like a bar of gold, for example, is fungible. Well, 1 bar of gold is the same as another bar of gold in theory, if it's all the same chemical composition, it's all the same. So they need fungible assets that they can buy and sell with a huge market. So these mortgage-backed securities, these banks go out and spend billions, tens of billions, hundreds of billions of dollars potentially at a time buying and selling mortgage-backed securities. So this is what the Fed was playing with. The Fed was buying mortgage-backed securities and treasuries. And the reason why the Fed buys these asset classes is because they're so huge, right? The US mortgage market is like trillions and trillions and trillions of dollars. So you've got a huge central bank like the Federal Reserve or even a big commercial bank like JP Morgan or Bank of America, like they need to be able to deploy $50 billion quickly, right? And so how do you deploy $50 billion? Well, you're not going to do it, buying art collection or whatever. I mean, that's it's going to take forever, right? You can't do it with a baseball card collection, but you can do it buying mortgage-backed securities because there's so many of them that you got a market with trillions and trillions of dollars. Same with treasuries, right? The US government has so much debt. So the market for US government debt is enormous. And so it's easy to go out and buy $50 billion at a time of treasury securities. So that's the thing that's the reason that they buy these types of securities. There are just not so many securities that you can buy that have that much depth in the marketplace. So that's why they tend to stick to these things. And so what happens is when we say that the Fed is printing money, essentially what they're doing is they're going to somebody else, like a bank, maybe even a hedge fund, but usually a bank, and they're saying, hey, you've got $50 billion of mortgage-backed securities. I'm going to buy your portfolio of mortgage-backed securities. I'm going to buy, hey, JP Morgan, I'm going to buy your $50 billion of mortgage-backed securities. And so here's $50 billion of in cash. I'm going to deposit it in your account, and I'm going to take your mortgage-backed securities. So now the Fed has $50 billion of mortgage-backed securities on its balance sheet, and they pay JP Morgan $50 billion. But where did they get the $50 billion from? They just created it, poof, out of thin air, right? They go to their, and this is the thing that, I don't know that anybody really knows, but there's some electronic mechanism. They go to their Fed supercomputer and they click in some keys and poof, $50 billion is just conjured out of thin air. From an accounting perspective, for our accountants and kind of financial wonks out there, what ends up happening is the Fed creates $50 billion on its balance sheet. They have $50 billion in liabilities that they create when they do that. And the reason is, if you ever pull out a US dollar bill and you look at it, it actually says on it, it'll say Federal Reserve note. And of course, a note is a type of liability. That's really what our currency is. US dollars are really Federal Reserve notes. And so they sit on the Fed's balance sheet as a liability. So now the Fed's balance sheet has $50 billion in mortgage-backed securities on the asset side, and $50 billion in Federal Reserve note liabilities on the liability side. So it balances. That's how accounting works. Everything has to balance. So JP Morgan now has $50 billion. The Fed has $50 billion in mortgage-backed securities and $50 billion in liabilities. And that's basically how central banking works in a nutshell. So the Fed does this again and again and again and again and again. So they went from $800 billion when they announced the first quantitative easing in November 2008 to about 2.1 trillion by the summer of 2010. Now, what's interesting is that very quickly after they announced quantitative easing, the dollar started to fall, right? So they announced it in November 2008. And then by sort of early to mid 2009, the DXY for our financial guys, the US dollar index is basically sort of the measure of the US dollar's strength relative to all these other currencies around the world. The dollar index started to fall. And surprise, surprise, as the value of the dollar index weakened, inflation started to rise. So, it's a pretty clear relationship. As the dollar weakens, prices get more expensive in the United States. That's pretty easy to understand. The U.S. imports a lot of stuff. Most of the stuff that people buy at this point is sort of made overseas. You go to Walmart or Target, or whatever, like most of that stuff is really made overseas. And so as the dollar weakens, it creates higher prices in the U.S. So fast forward a few months, in June 2010, they said, okay, we're gonna pause for now. But it didn't take very long, right? It didn't take very long at all. So June 2010, they kind of hit the pause button. Well, like 5 months later, and now it's November 2010, 5 months later said, okay, we're going to start this up again. And so now they had quantitative easing 2, or as the financial jokes call it, QE2. So QE2, they started again with their quantitative easing. And that lasted basically until the next summer, June 2011. Well, all throughout that period, inflation soared. And anybody remembers this now, this goes back 10 years basically, right? 10 years ago, we saw early 2011, suddenly, inflation was going through the roof. The dollar index, again, DXY, hit a low point certainly for the recovery. And that's when gold hit a record high for what was then gold's record high, was $1,900 and change, basically. So all that happened in 2011. People were really irritated, right? So you had significant inflation, and there was this hilarious press conference. I'll leave his name out, but the person that was the president of the Federal Reserve Bank of New York gave a press conference, and all these reporters in the room, and bear in mind, like I think they're headquartered in like Queens or Brooklyn or what, one of these, it's and where they held the press conference at least. And so, I mean, it was sort of in a working class neighborhood, and this guy shows up, and he was an ex Goldman Sachs, alum, and the reporters in the room were just like, dude, what the hell's going on with food prices? I mean, food prices going through the roof. And he said, well, but the price of an iPad 2 is cheaper than the price of an iPad 1. And one of the reporters in the back said, I can't eat an iPad. And that became known as the let them eat iPad speech, because it just showed sort of how out of touch the central bank is, where it's just, are you serious that, and then people are having to pay so much money now for milk and eggs and meat and potatoes and all these things. And he's talking about iPads. It's just such a massively out of touch these people were. So that was.
Would you say the situation is different right now, or the same?
This is a long way of saying that it's actually possibly repeating itself. And so the end of the cycle, you had then, so they ended QE2 in 2011, mid 2011. Then again, like a year later, they said, okay, we're going to do it again. So then they had quantitative easing 3, QE3. And they started that. They always had like different names for different things, whatever. But they had at one point, they had an Operation Twist, and I don't know who came up with this stuff. But so they started basically doing the same thing again. So in September 2012, now they said, all right, we're gonna buy $45 billion a month worth of securities. So now remember, go back to our sort of previous lesson about how does central banking work. Now you understand when they say we're going to buy $45 billion a month, they're going to create $45 billion. And then, so basically they have $45 billion goes on their balance sheet as a liability. And then they take that $45 billion worth of Federal Reserve notes and they give it to JP Morgan, Bank of America, and buy basically either mortgage-backed securities or US government debt. And this is pretty much how central banking works. So they said, we're going to do $45 billion a month of these purchases. So they're expanding the money supply by $45 billion a month. It only took them 3 months, and they said, oh, we're going to increase that to $85 billion a month. So by December, now they're creating $85 billion a month. That's, by the way, that's $1 trillion a year, more than $1 trillion a year. And, so they kept that going. The following September, and this was hilarious. So this kind of goes back to a little bit about like the Fed has no credibility. September 2013, the Fed said, well, we think over the next year or so, we're going to end this bond buying program. We're going to start raising interest rates. We think once the unemployment rate starts to loosen up a little bit and the labor market recovers, we're going to start raising interest rates again. And so the stock market had a hissy fit. And the stock market dropped like 5% like immediately, and people were panicking. And but it only took a very short period of time for the market to recover, because very quickly everybody realized that the Fed was full of shit, and that there was no way that in a million years they were actually ever going to have some meaningful interest rate increase. And people kind of realize, like, okay, they'll have some ceremonial, like, hey, look at us, everybody, we're raising rates by 25 basis points. That's 0.25%, big deal. But like, you're not going to see this, like they're going to jack up interest rates back to 7% or anything like that. And so that's, again, that whole sort of story of the past, I think, is where we are now. We're at this point where we're basically kind of in the middle of that sort of QE2 era, right? Mm-hmm. So remember, just quick review, everything collapsed. We had the first quantitative easing, inflation started to rise, and then they sort of tapped the brakes a little bit, but almost immediately went, to a couple months later, they started QE2 again. They said, we got to print more money. And then inflation went through the roof. Now, the same period, they actually kept saying, they were denying it, saying, oh, look at the iPad 2, no big deal. And that's when he first started hearing the word transitory. They said, it's transitory, it's transitory. And that's when they, they said, it's just a temporary phenomenon. And, then they started kind of threatening to take the punch bowl away with QE3, saying we're going to raise rates. And then everybody very quickly realized these people are, I'm calling their bluff. These people are totally full of it. And they're never going to do that. And I think that's kind of where we are today. We're in this point now where the Fed has almost no credibility whatsoever. And this is the thing, this is the article that I wrote today. Even the Biden administration, right? So the Fed insists, they said, inflation is going to be 2%. Watch it. It's going to happen. 2%. That's the number, take my word for it. Take it to the bank. And even the Biden administration is like, yeah, right. We don't believe that. Yeah. And so the Biden administration putting their long-term budget, forward to everybody saying, okay, here's what our budget's going to be. Their key assumption is they're assuming that inflation is going to be higher than what the Fed is promising. So even the Biden administration, they're not even willing to do it for show. They're not even willing to pretend to believe the Federal Reserve. That's the hilarious part. They're not even going to there's not even like an attempt at solidarity here to show yeah, we believe in the Fed's ability to control inflation. They're assuming a completely different rate of inflation than the Fed is projecting, which is hilarious actually. And I was actually reading about this in the Wall Street Journal this morning, is that they're even projecting that the Fed is going to have what you would call negative real interest rates, which are the interest rates after you adjust for inflation. So you look at something like, again, we go back to the idea of like bills versus notes. So you look at something like a 90-day T-bill, and they're saying, well, we think inflation is going to be, let's say 2.3%, but the 90-day T-bill is 1.3%. Well, if you're making 1.3% on your investment, but your inflation rate is 2.3%, that means you're losing 1% per year. Adjusted for inflation, your actual return is minus 1%, right? So that's called a negative real rate. And so even the administration, the Biden administration is saying, yeah, we don't think these guys are going to pull it off. They're not going to do anything. They're not going to raise rates. They're not going to touch inflation. They're just going to let it run rampant. And we're going to model it. We're going to model this ourselves. And the most hilarious part about that is that clearly the person that would have been super instrumental in putting the Biden budget together is none other than Janet Yellen, the current Treasury Secretary, who used to be the head of the Federal Reserve.
Yeah.
So even the people that come out of the Federal Reserve are saying, yeah, the Federal Reserve is full of shit. There's no way they're going to be able to get to 2%, which is hilarious. So it's like saying the Fed doesn't even have credibility with the Fed. And it's funny, but it's kind of sad. Yeah, it's a little bit sad. I would say. Yeah. So that's the position where we are. And I think we're kind of in that QE2 phase right now, where we see inflation soaring, inflation going through the roof. We're now, the most recent numbers, now we're talking about on an annualized basis, the month-on-month inflation on an annualized basis is north of 10%. Jeez. Right. And we've seen the same thing. So like this, so we have, what were the circumstances back then? Inflation's going through the roof. The dollar index hit a massive low, right? This is the same thing that we're seeing now. Inflation's going through the roof. The dollar index is hitting a massive low. The Fed is trying to pretend like it's all good, right? The Fed is spinning its web of creative tales to try and instill confidence in the marketplace. Nobody's buying it. Everybody knows they're full of shit. Even the Fed knows that the Fed has no credibility. The White House knows the Fed has no credibility. And, and we're in a very similar situation. The other thing that is similar is that in the last financial crisis, the federal government was very generous in paying people to not work. If you were unemployed, or you could pretend that you were unemployed, or whatever the case may be, you got all these benefits, and they just kept extending it. Like every 6 months, they would extend it for another 6 months and say, oh, here's this extra program, here's this extra money. And now the benefits are even more generous. Way more generous than they were the last time. And so I think if you want to be intellectually honest, the inflation started to tame in the last cycle when they took away the benefits, when they finally said, okay, you know what, we need to roll this up. This is getting a little bit silly now. And that was actually right, exactly. Get back to work. And that seems to be I think a major catalyst to, at least on the short-term basis, reducing the inflation a little bit. And this is now where we need to talk about what inflation really is.
Okay.
Now, if we were a normal podcast, this would be the point where we'd say, let's take a break and go to our sponsors. But we don't have any sponsors, so we don't do that. So we're just going to keep it going. Does all this make sense so far?
Yeah, absolutely.
Okay. So what is inflation, right? So inflation is really, the way I think about it is, it's essentially about, there's too much money relative to the amount of stuff in the economy. And stuff is really anything and everything. I was writing about it today. It's like, stuff is loaves of bread. It's a new car. It's a house. It's your investment portfolio. It's your, whatever, investments in cryptocurrency or stocks or bonds or, gasoline that you put in your car, everything, right? And so there's a certain amount of that in the economy. There's only so many loaves of bread that are made, every day, every year. There's only so many bushels of corn that are harvested. There's only so many cars that are produced. There's only so many houses that exist. There's only so many houses that are built. There's so many. There's only 500 companies in the S&P 500, right? So there's a limited amount of resources. There's a limited amount of stuff in the economy, and the way that, at least in market economies, work is that it's up to the consumer and it's up to the investor to allocate where that money goes. Consumers decide, every single one of us decides every single day. We get up in the morning and we go out and we spend money on stuff, whether it's gas in the car or whatever else it is that we're spending money on. And we're essentially making allocation, decisions about, where does that money go? And so because of all these individual millions, billions, probably trillions of individual decisions made by investors, whether they're huge hedge funds or, a little guy, who's just, going to the convenience store to buy a Snickers bar, everybody's making these decisions about where the money ends up. And so it's basically through the laws of supply and demand. If enough people want to buy loaves of bread, then, the price of the bread goes up. And if the price of the bread goes up too high, then, probably a lot of people are going to look at that and say, hey, that looks like a good industry. I'm going to start baking bread too. And now there's a lot more supply there's more loaves of bread because everybody's baking bread now, right? And so now there's a whole lot of supply. And so then that supply matches the demand and the price starts to come down a little bit. So it's the laws of supply and demand based on the individual decisions that people make relative to the amount of stuff in the economy. That's basically what sets prices. And of course, and then that's in a market economy. In a command economy, it's even more, it's totally ridiculous because the government gets to decide. And you and your mom have all sorts of stories about the Soviet Union and all this, but it's the government that gets to decide, how many boots and how many shoes and how many, all these sorts of things, making all these decisions.
You're supposed to eat, how much you're supposed to eat, everything. Yeah.
Yeah, exactly. So, and then along comes a central bank, along comes the Federal Reserve. And they say, oh, we think there's a problem somewhere. We're coming to the rescue. We're going to save the economy. We're going to save the world from the problem that we ourselves created, by creating too much money and liquidity in the last cycle. So we create this huge problem that we're going to come in and solve by creating even more money and making the problem even bigger. This is what they do. So you sometimes hear people say, they'll say that Fed's papering over the problem. Essentially what they're saying is they're just creating more money to solve a problem that was formed because the Fed had created so much money to begin with. So every time you just conjure money out of thin air, that's not prosperity. Prosperity is when real hardworking people go out and do stuff. They create stuff. They create valuable products and services. We talk about this every year in our entrepreneurship camps. You don't just get to conjure value out of thin air. Value is something that people, consumers, businesses actually need and demand and are willing to pay for. And you don't just get to conjure that out of thin air. Central bankers don't create value. They just print money. And they don't even print it anymore. They just hit a button and it comes into existence electronically. So the Fed comes along And now you've got this certain amount of money in the economy that is being allocated by, trillions of decisions by investors and consumers about where that money ends up relative to the amount of stuff that's in the economy and being produced by the economy. And then the Fed comes in, they just muck it all up and say, oh, here's a whole bunch of new money. There's boom, they just drop this, giant brick of cash basically in the economy. Well, now there's more money, but there's not any more stuff, right? It's the same amount of stuff. And so now,
it's even less stuff right now because so many businesses are closed.
That's right. That's right. Thanks to our COVID overlords, most of these, again, talk about unelected people that have enormous power over our lives. We have central bankers not elected. We have guys like, Lord Protector Fauci, not elected. Zuckerberg, not elected. All these people that get to rule over our lives and tell us what to do and what we're allowed to do, what we're allowed to read, what we're allowed to see, what we're allowed to say.
Sounds very familiar.
Right, exactly. And none of these people were elected. It's like sort of like how the Soviet Union worked.
Yeah.
So the central bank comes along with this giant brick of cash and they dump it into the economy. They didn't ask anybody, they just did it. The little committee met and they decided, here's what we're going to do. And now remember, let's go back to the lesson about how central banking actually works, right? So the Fed, they don't just, there's a joke, they call it helicopter money. And the guy who used to be the Fed chairman famously was talking about, I'll drop money from helicopters if I have to. So they call it helicopter money. But again, what they're really doing is they are creating money. They're creating a liability on their balance sheet, Federal Reserve notes, and then they're taking those Federal Reserve notes in electronic form and they're buying, they're paying, they're transferring it to, banks or whatever, usually banks, in exchange for some asset. And again, because the Fed has to, they're playing with such big numbers, tens of billions, trillions of dollars now, they have to focus on assets and asset classes that are enormous. And the biggest asset classes are treasuries, right? Because the government has so much freaking debt. So, when you have $30 trillion of debt, you go, oh, great, I can buy $2 trillion worth of treasury notes and bonds and bills and so forth, no problem. Or they buy mortgage-backed securities because the US mortgage market is so enormous, right? There are not a whole lot of other asset classes that are that big. It's possible, and I'll go ahead and say this, it's possible that at some point they might run out. And if they do, basically one of the only other assets that they could probably buy, they might start buying commercial bonds like Apple, Apple issues bonds. They might say, hey, okay, screw it, we're just gonna start buying Apple bonds. And there's some precedent for that, by the way. And the other thing that they would buy instead of sort of commercial bonds issued by private companies, the Fed would just go out and start buying stocks. The Fed would just start buying, say, hey, we're gonna buy 5% of every company in the S&P 500, right? Because
what happens to the stock price then?
Right. Well, of course, the stock market is going to go up, right? Because there's only so many companies, right? And you just keep throwing more money at it. And again, that asset allocation, that cash allocation is just going to push the price up. And they can do that because the stock market is big enough. It's one of the only asset classes that's big enough for the Fed to be able to effectively deploy trillions of dollars, right? They couldn't do that with baseball cards, right? They couldn't do that with sort of, the Fed's not going to go out and buy real estate, right? Because they couldn't go out and buy, we're going to buy 100,000 single family homes. Yeah. That would take forever, right? They're just not going to do that. What they are going to do is, now they have this whole issue, they're outsourcing some of that asset management to BlackRock and getting private companies involved to do that. And this is how a lot of that money is going to end up in other asset classes like stocks, even and like corporate bonds and things like this. So, but where it is primarily, again, it's important to understand the money flow. The money flow is very important. So when the Fed goes and they print money or they create this money, which we talk about, primarily it's going either to treasuries, which means it winds up in the pockets of the government. And then the government goes and they spend that money. The government goes and they'll sprinkle it all over the economy. And I will tell you, thank God the government is so incompetent. because most of the money the government takes, they squander, they waste, they spend billions of dollars on websites that don't work and all this kind of stuff. And honestly, if the government were more efficient at spending money, inflation would be like 40%. But they're so stupid at how they spend money. They're so inefficient and corrupt and all this stuff. Inflation is a lot lower than what it would be if they were actually competent, because if the government were competent, then there would be so much more money flooding the economy right now. But as it stands, just the bureaucracy and everything keeps that to a minimum because they're so inefficient. But that's a big part of it, is that the government gets this money, and now they've got they have a $6 trillion budget. And they want more. Now, they want more money for infrastructure and all these other things. And so all that is very inflationary. So when you hear, it's important to think about this, when you hear, stuff out of the federal government where they're talking about these huge spending initiatives, you've got to think inflation. That's inflationary, because the government doesn't have the money. They have to borrow that money, right? And where do they borrow the money from? They don't. I mean, a lot of people think, oh, they get it from the Chinese. They don't get it from the Chinese. The Chinese don't want to loan any money to the federal government anymore. So they get the money from the central bank. The Federal Reserve creates the money and ends up loaning it to the Treasury Department, and it goes through a complicated process. As an intermediary through the commercial banks. JP Morgan gets it first, or what's called the primary dealer window. It's a complicated process, but basically the Fed prints money, creates money, and then that money ends up in the pockets of the Treasury Department, which then goes and the government sprinkles it around all over the economy. That's inflationary, right? So you're talking about the same amount of stuff with more money. So that's inflationary. The other thing that they'll do, again, that the Fed will go out and buy these mortgage-backed securities. So remember, the mortgage-backed securities is a way to essentially, reconstitute the balance sheets, recapitalize the bank. So when you go to a bank and you say, hey, I need a mortgage to buy this house. I got this $600,000 house I want to buy. Can I have a mortgage, please? And the bank says, sure, here's a mortgage. Well, now the bank has basically paid, has loaned you this money, and now the bank is out $600,000. So what do? They pool all these mortgages together, and they go and flip them to there's these federal housing agencies like Fannie Mae and Freddie Mac. And those guys basically, they buy the mortgages from JP Morgan and Bank of America. So essentially JP Morgan and Bank of America get all their money back, right? They get all their money back, and all these loans end up on the books of these federal housing agencies like Fannie Mae and Freddie Mac, who then sell those bonds to the Federal Reserve. So basically they all end up, it's at the end of the day, there's trillions and trillions of dollars worth of mortgages where people don't even realize it, but they're basically paying the Federal Reserve interest on their homes. And it is actually talk about another bizarro conflict of interest for the banks. You look at this and say, why the hell do these banks even exist then? Why does JP Morgan even exist? They're gonna give me the money for all of 15 minutes, and then they're gonna go and flip it basically to the Federal Reserve and get all their money back. Why do they even do that? What's the point? Well, because they get to charge fees. Yeah. And anybody that's ever closed a mortgage, you look at that closing statement, you see it's like bank fee, bank fee, bank fee, bank fee. So JP Morgan puts money at risk for like no time at all. I mean, days, weeks, maybe, collects all these fees, charges thousands and thousands of dollars in fees, funding fees and origination fees and all these different fees. They put the fees in their pocket, and then they go and they sell the loan off to Fannie Mae, Freddie Mac. The Federal Reserve basically gives them all their money back. So it's a risk-free deal for the banks, right? It's a totally risk-free deal. The banks don't have to take any risk on any of these loans because they just go and they flip it back to the Fed, and they get to keep all the fees. And you look at this and go, this is like nobody else gets this deal. There's nobody who's listening to this podcast right now who has a business, whatever your business is, big or small. If you own a hot dog stand or a chain of daycare facilities, whatever it is that you do, you don't get this risk-free deal from the Fed where they get to go and recapitalize the whole thing, and you get to pocket a bunch of fees, fee income. But the banks get this. It's totally atrocious, completely atrocious. But that's the way the system works. So when they do that, the Fed goes and prints, creates money and buys these mortgage bonds. Essentially what they're doing is they're, in a way, encouraging the commercial banks like JP Morgan to go make more of these types of loans, right? So imagine if you're JP Morgan and you've got the Federal Reserve pumping out, $85 billion a month and saying, we want to buy residential mortgages.
Yeah.
And you're JP Morgan, and you're going, okay, I could go out and do like real business and actually take risk and, and work hard, or I can sit on my ass and just basically loan consumers enormous amounts of money, take zero risk, flip it right back to the central bank, and then pocket all this money in fees and basically generate all this income, and I don't have to do anything, right? What are you going to do? Clearly, you're going to take like door number 2 and do nothing and make all this money. And so it's this thing. I don't think anybody realizes it really how the system works. It's so incredible that the banks just get to generate this just like record fee income on their loans, because the Fed's just sitting there just cranking out cash, creating liabilities for themselves on their balance sheet to buy up all these mortgages. And so what does that do? The incentive is clearly in favor of the commercial banks doing more mortgages, right? And if the banks are out there doing more mortgages, well, make it easier for people to lend, they're loaning more money. And so all that, now you have this flood of cash. And so we were talking about before, in a market economy, it's consumers and investors that decide, where does that money go? Does it go into housing? Does it go into loaves of bread? Does it go into whatever? Well, now you've got the most, awe-inspiring, powerful force in the economy, the central bank, that's crunching, that's just this huge tidal wave of cash, throwing it at the banks as hard as they can and pushing it into one specific place: residential mortgages, the residential housing market. So you've got this tidal wave of cash flooding the residential housing market. Gee, what do we think is going to happen, right? Housing prices are going to go through the roof, which is exactly what's happened.
What's happening now, yeah.
Housing prices are at a record high, right? And they just keep going higher. And so a lot of this is, we talked about this a year ago, right? Saying a lot of this is people just wanting to say, screw it, I want to move, I want to get out of the city, I don't want to be, if this COVID shit ever happens again, I don't want to be anywhere near a city, I want to live out in the country. So we saw a lot of people leaving.
We still see that trend happening, especially people moving out of California and New York. Yeah,
that's right. People wanting to get away from crazy, rabid, ultra Marxist governments, and in San Francisco, get away from the COVID lockdowns, get away from the wealth taxes and the exit taxes and all these things.
Yeah,
yes, of course.
See what's happening in Puerto Rico right now.
Yeah, exactly. A lot of people coming to Puerto Rico, which we should talk about that sometime.
That's a different topic.
Yeah, it's a different topic, but the bigger force there is, again, just this ocean of money that's going into the housing market. And it's going into the housing market because the Fed is creating this massive incentive for everybody. They're creating huge incentives for borrowers, right? Mortgage rates are at these crazy lows. So big incentive for borrowers, big incentives for the banks, big incentives for everybody that's involved in this process, whether you're a mortgage broker or you're a banker or you're an investor or whatever, you're the guy packaging together the mortgage-backed securities. Everybody in every link in this chain is just making money hand over fist, because the Fed and this is where, like, you got to look at this and say, this is not a market economy anymore. This is now a Soviet command economy, where you've got, instead of saying we want to produce boots and we want to produce shoes and we want to produce, whatever, instead of boots, we want it all to go into the housing market.
Yeah.
So you've got this organization, and why the housing market? Literally, it's because that's the asset class that's big enough that the Fed can go and deploy $1 trillion. If the market for baseball cards was, $10 trillion, the Fed would be buying baseball cards, or they'd be buying securities backed by baseball cards. There'd be some investment banker somewhere packaging up, Babe Ruth baseball cards and these fungible securities to flip them to the Federal Reserve, and everybody be in the baseball card business right now. It just happens to be housing, simply because, by whatever luck of the draw, the housing market in the US is so big, it can absorb these multi-trillion-dollar capital flows from the Federal Reserve. And so because of that, the Fed is printing money, let's say creating money, expanding the money supply, buying these mortgage bonds, which essentially all that creates incentives for people to buy houses and push up real estate prices. And so all this has a, has a huge effect. It is very, very, very inflationary. And I hope everybody has like a lot better understanding about just the ridiculousness of this entire system and how it all works. But we should talk,
Yeah,
I guess, about sort of.
I feel like, I mean, at the end of the day, it's just people like you and I, investors, business owners, we're the ones that are getting screwed in this case. So this all feels a little bit depressing. What's the way out of it?
Well, yeah, you kind of have to feel a little bit screwed because you look at the banks and go, how do I get that deal? That's crazy.
Yeah,
right?
exactly.
But you have to have a huge, you have to be one of a handful of, one of the top banks in the country in order to get that deal. Nobody else gets that deal. But what we ought to talk about, the longer term effects, right? Because you pointed this out earlier when you said, we were talking about this. We go back to how we defined inflation. We're saying there's more money relative to stuff in the economy, right? Yeah. So again, now we have this tidal wave of cash now that's going all over the economy. And now we can see a lot of it is being channeled specifically into housing because there's all these incentives. And this is one of the reasons why we're seeing housing prices go through the roof. But on top of that, the money does tend to make its way into other places. So it makes its way into the stock market. Again, when you have this tidal wave of cash, and remember the S&P 500, you only have 500 companies. That's it, right? So if you have now all of a sudden an extra $2 trillion, and that's got to be split up across 500 companies. Well, like, of course, then, and some of the more popular, some companies obviously more popular than others. So you're going to see a lot of companies now, their stock price is going to go up. Their valuations are going to be stretched. By valuations, I mean, you're going to see what would a normal, quote unquote, normal price earnings ratio, a long-term median on a price earnings ratio, maybe 14, 15, 16 times earnings. Now, companies that are trading for, 30, 40 times earnings, 60 times earnings, 1,200 times earnings, and you can do that if you're Elon Musk. You just send out a few tweets and everybody goes and they buy Tesla stock. It doesn't matter. Anyways, that's also another topic. But again, this is one of the things that, and it's just a whole lot of other, things that we see just prices rising because again, assets, is included when I say stuff in the economy, whether you talk about the 500 stocks in the S&P 500, the 2,000 stocks in the Russell 2000, or you're talking about, cryptocurrency, most of which actually have a finite amount, or you're talking about, retail prices, the things that people buy, goods and services, how much your accountant charges you to do your taxes, all these sorts of things, your accountant has a finite amount of time, right? And so now all of a sudden there's more money, out there in the system. And so some of those things are going to be allocated towards accountants and the services that people provide, and lawyers and all those sorts of things. So all of this is basically inflationary. As you pointed out, we spent most of the last year under quarantine lockdown conditions. I don't want to comment a whole lot on that other than to say, just as a very quick aside, do you know where the word quarantine comes from?
I don't know.
So quarantine, this actually goes back to the days of the bubonic plague, right? So we're talking about now, in the 1300s, and you had, as modern evidence would suggest that, this came originally from rats that were on these ships, so you have the Italian merchant fleet sailing around the world. They brought the plague back with them. And so people did the same thing as today. They closed the borders and, people kind of locked themselves down. And the concept of quarantine is they said, okay, well, if somebody's going to show up, if some ship arrives to our shores, they're going to have to sit there for 40 days before they can enter the country. So, if they pass 40 days and they're still alive, then they're probably okay and they don't have the plague. Right, exactly. We'll let them in because they're still alive. And that means they don't have the plague. And so 40 days and French, 40 is 40, right? That's and right. So quarantine was, quarantine, basically. It was the idea of 40. And so that's where the word quarantine came from, is actually from the days of the plague. And the thing that I think is so interesting is that in our modern society, with all this technology and all these things at our disposal, we're basically, COVID protocols are basically the same shit that people did during the bubonic plague in the 1300s.
We haven't
So, right,
advanced at all.
Fauci is basically using the same playbook as from the bubonic plague from the 1300s. I mean,
Except
Cuomo and Gavin Newsom and all those
Yeah.
guys, it was basically, let's go back and see what they did in the 1300s, and that's what we'll do, because that's
I
what
feel
makes
like
sense.
I feel like it's been longer than 40 days.
Oh
Though.
yeah, it's been a lot longer than 4 days. So, anyways, enough of that. That's probably for another podcast as well. But so where were we? The concept of this, as you were saying earlier, that under quarantine conditions, you had all these businesses that either went out of business entirely, or
had
they
to
were
shut
forced
down.
to, right, they were forced to shut down temporarily. A lot of people were able to work from home, and my lawyers kept charging me and all that. I didn't get a break on any of that. However, a lot of companies weren't, you had companies that weren't producing, or you had factories that were still open, but they couldn't get people to come to the factory. Some people were afraid to go to work, or they just, the restrictions were too severe, whatever the case may be. So clearly all that was very detrimental to production. So if you go back to the idea of inflation as being, now there's too much money relative to the amount of stuff in the economy, and now your economy is producing less stuff, you've got more money and less stuff, clearly that's going to be inflationary. Now, at some point, remember, initially it could be, well, the money could go to certain categories of stuff. So maybe the money initially goes into the 500 companies in the S&P 500, right? It goes into shares in the stock market. It goes into bonds in the bond market, pushing up bond prices, pushing up stock prices, right? So maybe that's initially, you could say, maybe that's where most of the money comes from. But eventually it starts to work its way through the system. We start seeing, for example, big rises, big jumps in commodities prices, right? All of a sudden it starts going into oil futures contracts. So the price of oil goes up. And when the price of oil goes up, suddenly that starts affecting the price of everything. Shipping costs go up, which affects the price of anything that's got to get on a boat or a plane and be shipped to any place in the world. You start seeing, higher input costs for things that use those commodities, plastics, et cetera, agricultural prices, all these things start to increase. And, everything that's sort of higher up in the value chain, that stuff increases in price too. And so we started seeing this last year, Procter and Gamble and these big sort of consumer manufacturing conglomerates that were saying, hey, we got to increase the prices of our shampoos and our diapers and our
Everything,
whatever. Exactly. I mean, the meat companies increasing the price of pork and beef and all these things because they say, hey, we just can't do it anymore. We also started seeing not only sort of the price inflation as a result of that, we also started seeing value deflation.
Inflation,
Right, where you just got less stuff. And we were just talking about it earlier today, iPhones, and Apple came out and it almost seemed like it was a joke. And they said, oh yeah, we got this iPhone, but you have to buy the chargers separately. You don't get a charger, you don't get a headset, you don't get any of this stuff. You just get the box. You get to talk into it.
I was so confused when I was buying my phone. I'm like, so I need to, I'm buying this device, but I can use it only for a day. What happens after? Like, you have to buy this extra thing.
Okay, you buy this extra thing.
Does that make sense?
Right. Exactly. So that's value deflation, which is this. It's basically the kind of the converse of the inverse. The inverse of price inflation is you get value deflation, and so this is the thing that we experienced so much, is we had all this money and not enough stuff. And that's the part, again, to be fair, you could argue is transitory, right? That's the magic word, transitory. The Fed keeps telling us it's all transitory. It means temporary phenomenon. And that's true. Now you have these businesses that are reopening, and as the businesses reopen, then, well, guess what? They're going to start producing again, and there's going to be more loaves of bread, and there's going to be more, whatever produced. And because of that, now the money is going to be allocated more evenly across more stuff. So you have more money, but now you have more stuff. And so in theory, the prices start to fall a little bit. Now there's a couple issues with that. The first is, there's nothing a central banker is more terrified of than the dreaded deflation. Deflation is when prices fall. They never want deflation. They never want deflation. The reason for that is because they view deflation as this death spiral, right? Because if they say, if prices are falling, then people don't go out and they don't spend money because they just assume it's going to be cheaper next month and the month after that. So they put off purchases, they save their money instead of spending it. And these central bankers want everybody to spend money. And I always look at that and I say, isn't that sad? Because like individuals, we like falling prices. We think this is good. We go, hey, great, I'm getting a good deal. And two, I think this is so sad because it's like, savings is good. This is where prosperity comes from, is when people save money, they make good decisions. But to a central bankers, they don't like deals, they don't like discounts, they don't like low prices, and they don't like people saving money. They want people spending money and paying more for it.
They actually teach you that at the university. I mean, I studied economics. It's one of the first lessons you learn is like the economy grows only with inflation. You have to be scared of deflation because this is like going back, like this is the economy means shrinking.
But to a normal individual, we go, I like low prices. I like, being able to save money. This is good. And it is, honestly, it's totally pathetic because you look at the central banks, the people that lord over the system and control all this stuff, they want us paying more money and they want us not saving. And so to me, this is where like any rational person has to stand back and say, are my incentives really aligned with the Federal Reserve? Does the Federal Reserve really care about me getting ahead and all these things? If this is really what they want, you're just sort of this robotic automaton. You're not really an individual, just so much a mass of people where you're just a member of the consumer class to go out there and they just want you buying stuff, whatever it is, because that props up the economy. So this is the thing why central bankers hate deflation. And they will do whatever they have to do to prevent it. So now that the economy is kind of opening up and you have now productions going up, and you can see it in a lot of the statistics. One of the things that I look at a lot is something called capacity utilization. That's a fancy way of saying basically what is the country's sorry, I keep knocking this over. What is the country's capacity to produce stuff? Let's look at all the factories we have. We can produce 1 million widgets in a year. And how many widgets are we actually producing? So if our capacity is 1 million widgets and we're only producing 500,000, then our capacity utilization is 50%. And so during in the peak of the pandemic, capacity utilization in the US plummeted down to like 50-60%. Now it's back up to in the 70s, basically, 60s, 70s, early 80s, capacity utilization was like 90% in the US because the US was much more of a kind of manufacturing economy. Obviously, lots changed over the past several decades since we've been alive, and the US is now, more of a service economy, doesn't manufacture as much, but still the normal kind of capacity utilization is about 75 to 78%. And so right now, the US capacity utilization is like 74%. So it's almost pretty much right back to where it was, right back in that normal zone. And so now that that's happening, you could kind of make an argument that, well, now that capacity utilization is back, people are out there producing more, et cetera, that in theory, the amount of stuff in the economy will increase relative to the amount of money, therefore, supply and demand and prices should kind of start to fall. But the central bank's going to look at it and say, no, we can't possibly have that. Right? We can't have falling prices. So we've had this big rise in prices. And so they want to set a floor. That's their goal. They want to set a floor and say, we want the prices to at least stay where they are. So the prices jump, 10, 15, 20%. We want them to stay where they are and then go up from there. Right? Maybe not as high, but we want them to go up from there. And so that's their motivation. And to me, I think, to me, that's an impeachable offense. Because now your interests are no longer aligned with mine. My interest is for prices to go back to where they used to be. But the Fed doesn't want that, right? Because they're trying to lord over the economy and dictate whatever we're allowed to do, just like the public health officials were doing. So they have a totally different agenda. So they're going to prevent that from happening. And the way they'll do that is by just continuing to allow inflation to exist. And so one of the ways they do that is by keeping interest rates at very low levels. And low interest rates do create more, that it goes into some of the more esoteric parts about macroeconomics, about the money multiplier effect and so forth. As the economy starts to get hot and people are spending money again, you think about it like, you have a job, you go to work, you get your paycheck, you take that paycheck, you take your spouse out to eat, the restaurant owner gets some money, he goes and, buys a new car, and then the car salesman gets a commission. So you have this money that just keeps kind of churning around the economy, and it gets multiplied. You have this money multiplier effect. And so the lower interest rates are, the more that happens. And for a lot of reasons, one of which is there's more incentives to spend. You can spend more money on your credit card, credit lines go up, it becomes easier to borrow money. Probably a lot of people listening to this, especially if you're in the States, you probably got 3 different offers like in the last month for people, for credit card companies wanting to just give you money, just say, here, take this free, and offering you all sorts of bonus miles and all sorts of things like that. I mean, they're desperate to loan you money, and the rates are low. And so all these things basically keep fanning the flames of the economy. And as long as that's happening, it creates more demand and there's more money in the system. And so it keeps the inflation rate higher. So that's how the Fed is probably going to maintain at least a floor under where prices are right now, to make sure that prices don't go down, because they don't give a shit what you want. They just want to make sure that inflation stays, at some manageable number, and we don't have deflation. So I think this is one of the things to really look at for the short term, and why, when they say, oh, it's transitory, what they're really saying is, yeah, we get it, inflation is high, and what we're going to do is we're going to do our best to make sure it's not 10% per year, but it ain't going down. Yeah. The price is going to stay where they are now. What they want to do is just basically rebase everything to this higher level, and then go up 2 to 3% per year from here, right? So that's when they're saying it's transitory. That's really what they're saying. That's what they want. That's where their motivation is. What I guess the last thing we probably ought to talk about is why that's probably not going to happen, right? So you've got the short-term and the long-term trends here. And the short-term trends is exactly that. It's the Fed saying, hey, it's transitory. We want to keep prices up, but, slow the rate at which they grow from here on out. The reason that's probably not going to happen is because there's a lot of long-term forces at work that support higher prices and higher inflation. Some of them are by, I'm just going to be generous and say our own design. When I say our, I just mean sort of the country and the world as a whole. So they just came out with this policy. So remember, think about inflation. What inflation really is, it's more money relative to less stuff in the economy. And you've got now, for example, a new tax policy. They just announced. They say, okay, well, they've been talking about they want higher taxes in the US for a long time. They want to tax unrealized capital gains. That's the dumbest idea ever, right? Yeah. So they want to tax unrealized capital gains. With that's definitely going to make somebody think twice before making an investment. They want to raise the corporate tax. They want to raise it to at least to 28%, because they think that's competitive. I mean, these people are totally insane. So 28% is competitive. So they want to raise it from 21 to 28, but at the same time, they said, okay, we want a 15%, global minimum tax, right? So you got places like Ireland that do have a 15%. So Ireland's looking at this going, hey, this is fantastic, right? So now it essentially legitimizes other countries like Ireland or Singapore, that have these low tax rates that now, these are developed countries that multinationals can now go and relocate their headquarters and outsource a lot of their production to. So what they've essentially done here is they created a huge disincentive to say, please don't produce in the United States. We want you to produce, make Ireland great again. Make Singapore great. Yeah. Singapore first, Ireland first. This is what they're doing, right? So they're creating these policies. So they want to drive all this business and production and investment and so forth out of the US and into these other places. And so that creates a disincentive to produce. So we're talking about, this is the way you have to think about inflation. How much money is there? How much stuff is there, right? Well, now we're talking about incentives to, or disincentives to create stuff, or incentives to not create stuff here to create the stuff elsewhere, right? Mm-hmm. And when you kind of look at it, you see this like over and over and over again. We talked about COVID rules. And a lot of these things we say, oh, COVID's over. Like there's so many things about this that are just not over. Give me a break. And not to mention just the entire generation of hypochondriacs now, and every day people that can't go out and they got to scrub, whatever. You do you, and that's fine. But the point is, like, this stuff costs money. And you walk into a store and there's always somebody standing there ready to just douse you with hand sanitizer and all this sort of
that's
stuff.
their entire job.
Right,
This
that's
is all
entire
they do,
job
yeah.
is that you can't even say hello to another human being. Oh, hey, thanks for coming in. No, you got to just douse somebody with hand sanitizer and all this stuff. Well, guess what? That costs money. That person who's standing there costs money. You got to keep everybody out of the store. You can only have 10 people in the store, and everybody else has to form a line outside in the shopping mall. And so you got to have some bouncer, like it's a goddamn nightclub, just to go to the Gap or whatever. I mean, it's ridiculous. Yeah. And you got to have some bouncer, standing there, that person costs money. You got to pay somebody to do that. So it creates all these extra costs to do business. Restaurants.
And with the hotels, remember we were discussing, yeah.
Yeah, the hotels that are, these hotels that are saying, well, if a guest stays in a room, we're gonna let that room air out, right? So we get all the droplets. We got to get rid of all the droplets. So we're going to let the room air out for 24 hours. Well, so that reduces your capacity utilization. You'll never be able to run your hotel at full capacity because now you've got to keep this room vacant now for 24 hours. And on short trips, it means basically you could be at 50% capacity forever. That's and maybe worse than that. So, but you never run at full capacity. And that reduced capacity utilization means that you're going to have to make up for it by raising room rates. And so all these things, the restaurants are going to spend all this money on the cleaning and all these things that people didn't used to have to do. Now they got to, because the US is such a litigious place and all these businesses now that you need to go out and buy, bubbles that used to be cubicles, and everybody's got to go out. They got to buy 10 million masks and gloves and PPE and all those things that cost money. Yeah. Right. And so, at the end of the day, like somebody's got to pay for that. And all those things are inflationary. So, all the new regulations, feel however you want to feel about environmental regulations and even whatever sort of, social justice theme du jour happens to be. All that stuff ends up costing money, right? And so at the end of the day, somebody's got to pay for those things. That's inflationary. And these are just a tiny fraction of the forces at work. And then you got to look at the money side. And you got to look at it and say, well, you got a Federal Reserve that just loves, you got in the Treasury Department, you got somebody that used to be, the Fed chair. Now you've got the Fed chair, and they're both sort of lockstep. The Fed chair saying, we need more stimulus. And the Treasury Secretary going, we need more stimulus and we need all these things. And so clearly they're putting it out there. They're very much in favor of more stimulus. They're also very much in favor of a weak dollar. They might not say it, but the unofficial Federal Reserve policy is a weak dollar. And a weak dollar, as we pointed out when we go back to the beginning of this whole thing, we're explaining the origins of the last crisis and what happened. They print all this money. They have a weak dollar, a decline in the dollar index, DXY, that increases inflation, because now it costs us more money to import stuff from other countries overseas. And so all those things basically are just these huge forces where we've got more money, more inflationary pressure because there's either disincentives to produce or just input costs are higher, whatever the case may be. And honestly, that barely scratches the surface of all the other things that are out there. We're talking about this. I'm in agriculture. In the United States, there's a terminal decline in agriculture. It's extraordinary. There are fewer acres of farmland under production in the United States than have been since at least the 1890s. And yeah, sure, like the US is obviously a much more agrarian place, but it wasn't even the same size country back then. It's pretty amazing that farmers are quitting the business at a huge rate, and this doesn't even take into consideration the extraordinary negative consequences of the drought, severe drought conditions, record droughts in the West and places like California that are, that are such agricultural powerhouses in the US, and how that's going to impact them. And the reason this is important is we're again, think about inflation, where you've got now more money and less stuff. Well, there's less agricultural production. And actually, if you look at the USDA numbers, the US is doubling its food imports roughly every 10 years. It's about a 7-8% growth rate. on an annual basis. And, if you go back and you look at between, let's say now versus 2000, 2001, 2002, it's roughly about 4 times as much in terms of food imports. And so that's going to continue going higher and higher and higher. So now we're talking about a weaker dollar, having to import food from overseas with less domestic production. So, less stuff, more money in the system, specifically, having to import food with a weaker dollar. What do you think is going to happen to food prices? Right. So these are the sorts of things I think it's pretty critical to be aware of. If you look at the trends longer term, there are certain things that are transitory. There are things that the Fed's going to do its best to say, all right, we're going to rebase prices at this level and then try and stick to, this 2 to 3% annualized inflation rate. But you see a lot of things that will prevent them from being able to do that. All these other forces. The biggest one, this is probably the most important thing that we're going to say. The biggest thing that's going to prevent them from doing that is the fact that the federal government is totally broke. And I don't say that from a position of hyperbole or whatever. I mean, you just don't take my word for it. I encourage you to go look at you could Google or Bing, if you're one of the 7 people that uses that, go out and check out, the U.S. federal government financial statements. It's on it used to be on the FMS website. It's somewhere within the Treasury Department, but they actually print their own, basically the balance sheet of the federal government and their cash flow statements and everything that any business would do. And it's atrocious. It's atrocious. So, I mean, you're talking about, by their own admission, they are tens of trillions of dollars in the red. I mean, it's so bad. They even look at their own taxing authority and take the net present value of their future cash flows and take that as like minus 20, 30 trillion dollars. I mean, it's atrocious. So the debt level in the US is getting higher and higher and higher every year. At this point, it's just a joke. And this is not a political commentary. George W. Bush, 20 years ago, was supposed to be this hardcore conservative guy. And, he felt like he had his reasons, but I mean, the debt spiraled out of control under George W. Bush. And then Obama took over and the debt spiraled out of control under Obama. Trump did the same thing. Biden's doing the same thing. I mean, every one of these people has done the exact same thing. The national debt has gotten higher and higher and higher, not only in a gross level, but also as a percentage of GDP. Now it's well in excess of 100% of GDP and continues to rise, pretty much by the day. The reason why this matters is because the government is incapable of paying. Even the federal government of the United States has to borrow money, has to go into debt just to be able to afford to make interest payments on the debt they already have. Okay, so that's a bad situation to be in. If you can't even pay interest on your credit card bill without going out and getting another credit card and then charging all of the just the minimum payments on your other credit cards and charging that to a new credit card, that's pretty much game over, right? And so that's where the US government is. And so basically they have this luxury of every month, the Federal Reserve shows up with a new credit card offer for them. And then the next month it's like, hey, we got hey, Uncle Sam, here's another credit card offer for you. And this happens month after month after month, but the bills keep getting bigger and bigger and bigger. So if inflation, really does rise, and again, there's a lot of reasons, so many reasons, we just barely scratch the surface of those kind of long-term inflation forces, not to mention the obvious short-term ones. The fact that, interest rates have been so low for so long, and this creates an overheated economy, the multiplier effect, all these things. The obvious thing for the Fed to do, and the thing that central banks do when they want to control inflation, is they raise interest rates, right? They're not really able to do that anymore. And again, they'll have just like they did in the last cycle, they have their ceremonial interest rate. They'll have hey, we're raising interest rates increase. That'll be the one that say, hey, everybody, we're raising interest rates by 25 basis points, and they might do that a couple of times. And that's it. Because the US government, and honestly, most US consumers and a lot of businesses cannot afford even 1%, for the federal funds rate. That's too much. It's too expensive. And you talk about rate, it used to be, 4, 5, 6, 7%. I mean, in the 80s, it was 15, 18%. My parents had a negative amortization mortgage at 16%. Which meant negative amortization meant that the principal balance on the loan increased every year. Instead of paying down the mortgage, you actually, the mortgage balance was increasing every year. Plus they're paying 15, 16% on that. So, you know, I mean, talk about bankrupting. And so there is no Fed chair, past, present, or future, that wants to be responsible, wants to be the person responsible for bankrupting the federal government because they raise rates to, 5%. If the US government had to pay 5% on $30 trillion in debt, that's $1.5 trillion a year, just in interest, plus all the other stuff, right? I mean, it would be so debilitating. They would go bust instantly.
It's not going to happen.
Instantly. So nobody wants to do that. So because of that, and they know that. And so for that reason, the Fed's just not going to raise interest rates. They can't. The only way that it would be remotely possible is the federal government would just have to start defaulting. And I've written about this a lot of times. They can say, oh, we're going to default on the Chinese. They make up some excuse, say China's, you're very bad people, you flooded the world with COVID, and so we're gonna default on your debt. Okay, fine, but that's only a couple $1 trillion, right? You could default on the Russians and the Chinese and all these guys, but it's only really a couple $1 trillion. It doesn't even. It's like 5 months worth of new debt. It doesn't really move the needle, right? Who owns all the debt? Well, it's the Federal Reserve, it's the Social Security program, all that stuff. So what are you going to do? You're going to default on Social Security? Right? You're going to default on, a couple 100 million, past, present, and future retirees that are paying into the system every year, and risk that. No politician wants to do that. Who else are you going to default on? Who owns the debt? Commercial banks. You're going to default on the commercial banks and spark a massive nationwide banking crisis? No, you can't do that. It's not politically palatable. And the other is you'd have to default on the Federal Reserve. But if you default on the Federal Reserve, now you create a currency crisis, right? Which is not only felt domestically, but all over the world, everybody that holds US dollars. And so it's just a really difficult position to be in, which means that the only way really is for them to just keep holding interest rates down. Say, oh, we got up to 1.25%. I mean, that's pretty much the maximum you're looking at now. They just can't, they don't have an option otherwise, which means that all these other inflationary forces, whether it's the tax policy or just the general overheating of the economy or the stupid regulations or the COVID protocols or any of these general trends that we're talking about, the agricultural stuff, whatever, the farmland, all these things, they're just not going to be able to do anything about it. The Fed does not have the maneuverability to tame interest rates, to raise interest rates to tame inflation. They just can't do it. And that's the really critical thing to understand. It's not like this is going to happen tomorrow or 6 months from now, whatever. There's a lot of very smart people. What's the guy's name? I always can't pronounce. Dalio. I always forget. Ray Dalio is the guy who runs hundreds of billions of dollars, whatever, in assets. Talking about, he's got a crystal ball and saying that he thinks it's going to start happening this year. I'm not that intelligent, so I wouldn't be able to say it's going to start happening this year, but there are a lot of very, very smart people, far smarter than I am, who think it's going to happen this year, who have already been writing very heavily about this thing. Bonds are stupid investments, negative real rates, all these things that we talked about. You got to get your money out of this stuff. You got to start expanding internationally. You got to, start looking at safe havens, that are outside of the US dollar, all these sorts of things that honestly, we've been writing about for years.
Well, I think that's we've been talking this for over an hour now. I feel like we can agree that the inflation is here to stay. I don't think this is transitory. This is not temporary. But can we leave the listeners with some tips against inflation?
Yeah. So again, I think we could see, I think it's entirely possible we could see some kind of transitory. Again, we see a higher a higher rebasing of prices. Some prices are going to come down. Other prices are going to stay high and continue going higher. And I think we're going to see that. And then we might see some period of time where we're back to from this higher level, 2%, 3% annual inflation. And maybe we see that for a little while. And then all of a sudden these other forces come into play. And then we start seeing 4, 5, 6%. 10%. I don't know when exactly that goes. I want to be realistic and say, yeah, it's possible that it could kind of, fall. It could kind of calm down for a little while and then it starts to creep back up again, or it just gets totally out of control. I don't know. We won't know until we have the benefit of hindsight. But in terms of, geez, what does somebody do about it? First, I think you've got to acknowledge that it's an issue. So you've got to be better than your central banker. You've got to acknowledge that this is a real issue. You can't just dismiss it and go, oh, nothing to see here. It's just transitory because they told me so. Don't take my word for it. Just look at it, look at the situation yourself and see what are the forces at play. I would say one point, like people say, well, one of the great sort of balancing mechanisms against inflation, there are a couple of them. One of the great balancing mechanisms against inflation, they say, is technology. Technology, it's always kind of thrown about. People say technology is very deflationary because, again, the price of the iPad 2 is less than the price of the iPad 1. And I look at that and I go, that's bullshit. I mean, an iPhone is $1,500 now. You got to spend $1,500 for a phone. Of course, not every phone costs $1,500, but it's like, okay, yeah, sure. Like the little candy bar, Nokia type bar phone that we used to buy 15 years ago, and that was whatever, $300. I mean, I remember I had what was that flip phone called? The Motorola Razor. That was a super sexy phone. It was this thin, sleek, and that was expensive. I don't remember how much I paid for it, but boy, that was pricey. And you could buy, one of those old school like flip phones like that now for like nothing. But nobody uses that stuff anymore. In terms of the technology that we actually use, it actually, kind of continues. The most dominant technology in our lives generally does tend to get more expensive. And, and then, if we think about, especially like they throw out the word technology now, Netflix is a technology company, Amazon's technology, all these guys are technology companies. So, but you look at Netflix, like, well, Netflix goes up on its prices all the time. When was the last time, when was the last time a Netflix subscription went down? It doesn't go down, it goes up.
Can imagine that happening.
Right, exactly, it goes up. And so the prices for the stuff that we pay in technology go up. So I just throw the red flag and stuff. No, that's just every time I go, oh, technology is deflationary. No, it's not. It's just not. There are certain things that technology creates better productivity in certain ways. But if you actually look at the macro picture, productivity in the US is actually falling because most R&D, and this is probably a whole other topic, but most research and development in the United States, it ain't for like, the grand, big technology. It's all consumer tech stuff. Like research and development, the big research and development budgets are in places like Facebook, trying to get people like us to click more on, how to click more, how to engage the user more in butt selfies and stuff like that, how to make it easier for somebody to airbrush their imperfections out of their selfie photo. That's where the R&D is going. That's supposed to make and make the world a better place, right? But it doesn't actually improve anything. It doesn't make anybody more productive. And so because of that, it's not really deflationary. Deflationary technology creates more productivity. And like, we don't really have that anymore. In fact, most of the R&D technology is in consumer tech, which actually decreases productivity because it's also goddamn distracting, right? I mean, it's stuff that makes our life at this point really more difficult rather than less difficult. So the other thing that people say is deflationary is competition. They say in a capitalist economy, you have all this competition. So companies all kind of dive in and the people with the most efficiency rise to the top, and it creates price efficiencies and all that. And yes, in theory, that's true. And Adam Smith would have argued for that when he wrote his book, which coincidentally came out in 1776, I believe, The Wealth of Nations. And the idea behind that is that in a true market economy, you do have this competition, and that competition is deflationary, but we don't really have that anymore, right? We have an economy where certain industries, like very big banks, get this ridiculous benefit by having this no risk approach to capital allocation. We get to just shower themselves in revenue. We get the tech companies that get to lord over us. We get all these things, and then you've got governments that create insane amounts of regulation, preventing small businesses from ever getting off the ground. Mm-hmm. And when you have those types of situations, you have to have all these things and all this whatever. Now we've got even more regulations, COVID protocols, all these things. And when you have so many rules that prevent people from being productive and prevent people from getting out there and competing, you don't have the competition. you certainly don't have the competition that you should or would have otherwise.
Yeah.
And so that's anti-deflationary in that case. So those are my arguments against that. So, you know, what does somebody do about it? Well, I think, again, you've got to recognize that it's an issue, and it matters. You know, really, it's always mattered, but I mean, it matters how you make, again, where individuals making allocation decisions about what do we do with our money. Does it go into, you know, stocks or bonds, or, you know, bags of rice and loaves of bread and all these sorts of things, whatever it is, you know, we make these allocation decisions. It does make sense to consider inflation in the back of your mind. And I think you've got to recognize that if you've got, you know, there are people out there, I won't mention any names, let's just say somebody that gave birth to me, you know, listening, that likes to sit on cash and just, you know, cash just sitting in a bank, you know, earning 0.01% interest.
Losing value every
right, just going to
single
losing
day.
value, right, losing value every single day. And
Yeah.
you know, there's just better places to put that. And you know, we don't give investment advice. We're trying to be very clear about that. You know, we try and just provide ideas and insights and information and let people make their own decisions. I mean, my personal, and I've been pretty clear about this. I mean, that the investments that I've always favored, this is my personal opinion, is a great business. I like businesses because in times of deflation, when prices are falling, the most valuable thing you can have is cash. And a great business throws off cash. It generates positive cash flow. So you get cash from a great business. In times of inflation, a business is able to hold and maintain its value against the rising prices, which is great. In times of in a good economy, the business makes a ton of money. In a bad economy, a great, well-managed business is able to consolidate market share because a lot of inferior competitors go under, to be able to consolidate market share and actually emerge from that in a stronger position than you've ever been. So I really like great businesses. And I'm not even talking about whatever, investment fad du jour on the stock market or any of these sorts of things, because a lot of those companies don't actually make money. And I talk about this a lot. All these companies that are insanely popular and either hemorrhage cash, or if they make money, they make this tiny little bit of money, or they make money because they use a bunch of accounting gimmicks. And if you dive in their cash flow statements, they actually make nothing, or they're losing cash, they're operating
And
cash
they're
flows
stupidly
negative.
overvalued.
Right, they're stupidly overvalued. People often don't even dive into this stuff. I mean, I don't want to beat up on Tesla because I have no emotion for any of this, but I use it as an example. One of the things about Tesla, for example, is that they had at one point they said, "Oh, hey, we turned a profit," and they started generating some positive cash flow. But then analysts started to actually dive into the financials. They realized, hey, wait a minute, they're actually losing money on their cars. They're making money because they're able to trade all these carbon credits, environmental credits and stuff to other companies. And so they get to sell those. And that's where they're actually making the money, not on their core business, which is, actually producing cars. And so, these things kind of change over time, but, you sort of look at these things and I look at that and I go, that's not really a great business. A great business is something that at least has the potential to generate significant amounts of cash flow and grow, and is run by talented people of integrity, whether it's public or private. And so this has always been a thing for me that I feel like is, these are the things that I like to invest in, be part of, accumulate, start, et cetera. And I think now in particular, there are just a lot of, one of the things to be thinking about, I think a great business is an excellent inflation hedge. Because a great business, again, will consolidate market share, will be able to maintain sort of the purchasing power of its equity because it's growing the business with inflation. A well-managed business is able to control costs. So it is taming inflation internally, but it's able to use inflation to its benefit and generate more revenue, right? So it's it gets a boost from inflation if you've got a well-managed business. And so to me, this is a very sensible thing. I think the right businesses are businesses that are able to, it's a weird time in a labor market, especially I think in a place like the United States. that has been so, we'll be polite and say generous with its unemployment benefits and paying people to stay home. So the kind of, I think, businesses that make sense are businesses where if there's a big employee requirement, it's one where that production can be outsourced overseas somewhere where there's a much lower cost, obviously, of production labor, or a business where you've got the ability to leverage a smaller workforce and generate a lot more revenue from that. So, I mean, a lot of people think, oh, that's technology. Yeah, sure, technology maybe, but I also think technology, as I mentioned earlier, is a moniker that's thrown around that applies to everything. People used to say, you know, we just watched that WeWork documentary, which is quite good. You know, and they say, you know, WeWork tried to pass itself off as a tech company. You know, everything's tech. Everything's tech. Like if you have some technology, if you use technology, you're a tech company. Everybody's a tech company, right? So like WeWork wasn't a tech company. They insisted that they were not a real estate company because they didn't own real estate. Okay,
Yeah.
big deal. You know, it's like there's plenty of farmers. You know, they're farmers. But they don't own their farmland. They lease their farmland. Big deal. It doesn't mean they're not farmers. They're still
Well,
farmers.
if they have an app, it's a tech business.
Yeah, exactly. If you're a farmer with an app that doesn't own the land, only leases it, yeah, you're an agri-tech business. So, but this is the way people look at this stuff. But I think, yes, honest to goodness, bona fide technology companies can leverage this stuff. And like we've invested in a number of these, you know, we've got a couple of AI companies. You can have a relatively small team develop software, and software is great because you can leverage that software and sell it to lots and lots of people. But I think there are a lot of other examples, and sure, certain things that, you know, people develop platforms and all those sorts of things. Okay, sure, like those are I think, you know, you could argue technology companies as well to a degree, but I'm talking about sort of beyond tech. Honestly, even things like media, where with a relatively small workforce, you can be in the content creation business. And now you've got, you know, product you sell worldwide and all these sorts of things. And so that's actually a pretty smart business to be in. I think these days, distribution is a really good business to be in. You know, we've seen this ourselves, how rapidly, you know, within our own agriculture business, how rapidly our distribution division has grown. It's been astonishing. And, you know, we wouldn't have been able to do that if we didn't have the production that we have. But, you know, we are able to stand up a very small team and dramatically increase the bottom line with a very small team, being able to do that. So distribution is something I think makes a ton of sense. You know, to be in those types of businesses. I think there's a lot of other examples.
How about agriculture itself?
Well, I mean, when you talk about this whole, I mean, I'm in agriculture because of the agriculture trends, and you look at what's happening in the U.S., and it's not just in the U.S., it's in a lot of other countries as well. It's funny because when I was looking at some of the data for this, I was going back and looking at census records from the federal government, going back to the 1800s, where they were getting data on the number of farms, the number of farmers. I mean, it's like back when Kansas was still a territory and stuff like that. I mean, it goes back a really long way. And it's interesting because you can see the prices of farmland that people were paying in the 1870s and the 1890s and the early 1900s. And honestly, it's been just objectively speaking, it was a really great investment, and has been continued to do so. If you take the average sort of price per acre of farmland going all the way back to the 1890s or 1950s or wherever you want to base that, through today, it's been a hell of an investment, and not even take into consideration the chain, the yield, the income that you generate off of. We bought a farm in Chile off of a guy who he's an older guy, quite an old guy, and he'd bought the place like in the 1960s, right? So you can imagine what farmland prices were in South America in the 1960s, and the guy wasn't doing anything special. He was just planting wheat. But the yield that he was getting off of it, relative to how much he paid for the land in the 1960s, I mean, the guy was making like 10,000% per year relative to the initial investment that he had made. It reminded me of, when Warren Buffett was talking about, Coca-Cola. They bought Coca-Cola, and now like the annual dividend they get is more than the entire amount that they paid for their investment, back. And so, this is the kind of, not a recommendation to buy Coca-Cola or farmland or anything else. It's really just, I think, maybe a different way of thinking about things. But I think we talked about some of this before. I wrote about it. you definitely have to have a long-term view. You definitely have to think about things that you might not normally think about. You know, I mean, management is everything. People in businesses are everything. It's why I like business more than other asset classes like real estate. Because if you buy real estate, nothing wrong with real estate. I think real estate's great. And a lot of people made a ton of money in real estate. You know, I've dabbled in it here and there. But I always kind of look at real estate and say, well, you know, if you're, let's say you're buying residential real estate, want to get into 3-bedroom, 2-bath house, that's kind of where a lot of people always start, and something like that. And you're in a neighborhood and it's like, well, there's only so much you can do to increase the value of the house. You come in and you change the bathroom and renovate the kitchen and all those sorts of things, but there's only so many things that you can do. With a business, you can start with nothing and turn into something that's worth billions of dollars. There's no limit to what you can do with a business. And it's really all about the ingenuity and the creativity and the talent of the people that are running it. So it's just, I like things that have unlimited potential, because I believe that truly, you know, in all human beings have unlimited potential. And I think business is one of the great ways to bring out that unlimited potential and creativity and ingenuity in human beings.
And I actually think we can talk a lot more about the businesses. I mean, I just watched the applications for Parallel 18. I think there's so much that we can share about this if someone is interested in creating.
I think we should talk about it. Yeah, we should definitely talk about that sometime, because yeah, you're on the selection committee for this. Is one of the it's like an incubator accelerator type program in Puerto Rico, and it's pretty cool. You get a lot of interesting you know, kind of interesting deal flow from that. So look, we could talk about that another time, but there's a lot of other stuff we want to talk about. Inflation, maybe we'll save it. We, of course, we can talk about gold, we can talk about crypto, we can talk about a lot of different things, but
we'll keep it for next time.
We'll keep it for next time. Yeah, we've been going for a while here. So this was cool. This was a lot of fun. And if you listen this far, appreciate everybody's time and attention. Thanks, Viktorija, for hosting this.
Thank you, James.
Wouldn't be able to do it on my own.
We'll be doing more of these.
Yeah, cool.